Alright, hi there. Every once in a while, in the world of investing, the following question pops up. Can you beat the market? Or maybe I should say, can you still beat the market? Because there are many famous investors who have proven over many consecutive years that you can indeed earn a better return than the broader stock market. Investors like Warren Buffett, Joel Greenblatt, Mohnish Pabrai, Guy Spear, and many more, they've beaten the market for, sometimes more than multiple decades, which over the long term can translate into far superior returns than the broader market. But I guess in the context of the rise of AI, this question will once again be asked by the media. And I've recently watched an interesting presentation that Mohnish Pabrai gave at the London School of Economics, in which he discussed an interesting dynamic of the competition in the world of stocks and the advantage that you as a small, private, retail investor enjoy. And today I want to talk about these things, so without further ado, let's get started. Alright, I already mentioned it in the intro of this video. Will the rise of artificial intelligence make it much harder or even impossible to beat the broader stock market? After all, ever since the launch of ChatGPT, I think by now around 1.5 years ago, at least that's when the chatbot by OpenAI gained widespread media attention and recognition. Well, ever since, I think people realize how much power AI actually has developed in the more recent years and how powerful it will potentially or likely become in the subsequent years, especially if you consider the exponential growth that is to be expected in that space. And you don't need to be particularly creative to come up with a scenario where AI might replace human investors who pick stocks themselves. However, I would argue that there are actually many characteristics of the art of stock picking that make it hard for AI to ever replace human beings. I'm not saying this will never happen, but I don't see it happening in the near future. And let me briefly explain why. So first of all, and I'll keep this point fairly short, I think investing is both art and science. Obviously, there are a lot of numbers and quantitative factors involved when it comes to picking the right stocks that will deliver great returns over the long term. But arguably, all of these quantitative data points, they are already quite efficiently priced. Like I would say information is readily available, much more readily available than say 2, 3 or 4 decades ago. And also the speed of processing of this information has improved spectacularly. I mean, all you have to do is look at the after-market performance of a stock of which the underlying company was reporting earnings after the market closed. And many algorithm-driven market participants will move their stock up or down, significant percentage points much more quickly than any human being could ever digest the information included in the earnings results. However, as I said, there's also a qualitative side to investing, talking to management, for example, truly understanding the company culture, the business culture, truly understanding the incentives of the management team. Are they driven by financial incentives? Are they giving everything they can because they have an emotional stake in the company?
I'm the founder and CEO. I'm responsible for the health of our company, for our direction, and for deciding how we execute that, including things like this. And
I could list hundreds of factors that are of qualitative nature that are much harder to assess by a computer effectively. And then secondly, I think there's another edge that retail investors, so people who are managing small sums of money in particular, enjoy. And those advantages are often unnoticed or arguably not often enough talked about. However, Mohnish Pabrai briefly touched upon these in a recent talk. And let me just quickly talk about them myself. So first of all, we, the small retail investors, we have, unlike institutional investors who are often tied down by rules and regulations, we have the freedom to explore the whole spectrum of the investing universe. We can invest in whatever assets we want. We can invest in stocks from all around the world, so we are not required to invest in Canadian stocks only, in German stocks only, or European stocks only. We can invest in companies that are operating in all sorts of industries. We can invest in companies of different market capitalizations. The smallest company in my portfolio right now, for example, has a market capitalization of around 40 million euros. And the largest company in my portfolio, Google, has a market capitalization in the trillions. And then finally, we can also size our investments in whatever way we want. If we want to put 50% of our portfolio into one stock, we can do it. We can do that. And institutional investors, they are usually not able to do that because of some of the constraints they have by their fund mandate. And obviously there are other advantages that we as private investors have. For example, you could discuss the flawed incentive structures of the fund industry. I'm not going to discuss this in detail here, but just for example, look up the term career risk in this context. What also comes to mind in this context is the famous quote that no one got ever fired for buying IBM. And one advantage that I just mentioned is related to the market capitalization of different companies. So unlike most bigger players, most institutional investors, private investors can invest in the so-called microcap space. Microcap space, well, what do I mean by that? Well, I'm basically referring to companies with a market capitalization of around 50 million US dollars to around 250 million US dollars. Depending on which definition you look at, the numbers may vary a little bit, but basically the smallest companies that are publicly traded. Yeah, and as I said, these companies often fly under the radar of institutional investors because these companies are simply too small or too illiquid for them. And you know what? That's a good thing for us because that means there's less competition for the retail crowd. With all the big institutional investors hunting for bigger companies, that leaves more room for us to find discrepancies between price and value. And that's why arguably microcap stocks are also oftentimes less efficiently priced than their bigger counterparts, which will ultimately allow you to achieve market-beating returns. Which brings me to the second dynamic of stock markets and another advantage that the small retail investor has over bigger competitors. And this is what Mohnish Pabrai recently talked about. And I'll suggest let's just briefly take a look at what he had to say.
The other thing about investing to keep in mind is that when someone is a really good investor and they have small amounts of capital that they're working with, let's say someone is an exceptional investor, they have $5 million that they have under management. Their universe is very large. They can invest in almost anything because they could make, $500,000 bets or something. As the world finds out about them and the 5 million under management goes to 5 billion, for example, they can no longer make $500,000 bets. So they have to move up the food chain, if you will. And when they move up the food chain, the bottom of the food chain gets emptied out, which means that space becomes available to new entrants who can only make $500,000 bets. So the nature of investing is that the very smart brain power that is initially at work at very small nooks and crannies of the market, by definition, that brain power will move away from those nooks and crannies because they'll get successful and they'll move into larger, greener pastures, larger pastures. So value investing has this kind of notion where continuously the bottom is being emptied out for the next generation to come in. So for all of you, if you have small amounts of capital at your disposal, you have a huge advantage. And I would think that as long as maybe you can deploy AI to, give you some speed. But I think at the end of the day, I don't think there is really a substitute for the deep dive and really kind of understanding things because so much of it is non-quantitative and so much of it changes so much from one company to the next. The circle of competence comes in a big way.
So what was Mohnish Pabrai saying here? Basically, he was saying that luckily, again, that's a good thing for the small private investors. Luckily, the best investors that are competing with us in the microcap space. So in the space where we are investing in the smallest companies available on public stock markets. Well, the best investors, they will at some point be forced to move up the food chain. Let's say there's a fund manager, for example, that is managing, I don't know, maybe he's starting with 15 million US dollars under management. And let's say he can achieve a return of, 22%, which is obviously incredible. He's absolutely, or she is absolutely crushing it. Well, let's say he or she compounds at that rate for 15 years. Well, then after 15 years, he or she will be managing close to 400 million US dollars. And this is not considering fund inflows because if an investor is doing so well, so a professional fund manager that is starting out small, well, obviously this will attract other investors to invest along with him. And very quickly, that professional that is doing incredibly well, that is sniffing out the discrepancies between price and value, he will no longer be competing with us, the small guys, the guys investing tens of thousands of dollars or maybe hundreds of thousands of dollars or maybe even 1, 2, 3, 4, 5 million. Because that fund manager, once he's getting to, say $500 million in assets under management, well, he will hit some limitations. Some stocks in the microcap space are so illiquid that he will not be able to build a stake in that company without significantly affecting the stock price. And exiting the positions may be difficult too, which represents a real risk for that investor. And then second of all, investing in, say, a 50 million US dollar company. Maybe he's acquiring a stake of 10% in that company. that will no longer really move the needle for him. So he will naturally be forced to look for bigger companies, small cap companies, mid cap companies, or maybe even larger companies. And I would say that dynamic of stock markets and stock market investing, this is something not a lot of people talk about. And so I just wanted to very quickly share that idea with you. Let me know what you think of it in the comments down below, and I'll see you in one of my next videos. Take care.